the rudiments are pretty simple. Banks behave sensibly, but they might fail if they don't. We should have as little regulation as is needed. And the central bank must know how to behave, and that is to act as a lender of last resort. When these elements are in place, we should be absolutely fine.
Welcome to the IEA's YouTube channel. The failures of Silicon Valley Bank and Credit Suisse have very much sent shockwaves through the financial sector. But beyond the immediate consequences, this market turmoil raises more foundational questions about what should be the role of central banks and governments during a crisis, and what is the state of banking regulation, and why do these crises keep on coming time and time again? To discuss this very timely and important topic, I'm very excited to be joined by two leading experts on monetary policy, banking regulation and financial crises. Professors Geoffrey Wood as well as Professor Forrest Capie, who are both very extensive academic pedigrees across various universities. Between them, they've written and edited dozens and dozens of articles and books about banking and economics, lectured across universities in the UK and elsewhere in the world, as well as advised central banks and governments. Professor Capie is a former official historian of the Bank of England, while Professor Wood has also worked at the Bank of England as an economist. So I was looking through your backlog, and you wrote a book in 1986, or at least you edited a book in 1986 called Financial Crises in the World Banking System. So it very much must feel like a bit of a deja vu today, watching again as the banking system struggles. Why do you think we keep facing these? What can we learn from history?
Well, I would like to take you back to history. You spoke of crises being frequent. You obviously haven't looked at British economic history, because Britain had no financial crisis from around 1850, certainly, until well into the 20th century. And this is very interesting because there was also a period when British banking was completely unregulated. Indeed, regulations were eased, and the easing of regulation in the 19th century made the banks more stable. But regulation was brought in first in 1979. So regulation really brought in because we were joining what was called then the European Common Market, if I remember correctly. It was brought in by them. Until then, Britain's financial system was essentially crisis, if it was crisis-free. The occasional bank failed, but that was part of maintaining a stable system. So put on the one hand then Britain, with no specific regulation for banks, which is the country which has had roughly over the same period the most banking failures per year. This is the United States, which had a very regulated banking system. When I taught this to students, I was in the habit of telling them, and I could say this without even looking at the year, that there were more banking failures in the US in the past year than there were in Britain in the past century. So this suggests that the calls for regulation that we're seeing are not necessarily well conceived.
It's a difficult question, I think, you ask there. Why does this keep happening? Can we not learn from history? And as Geoffrey says, there was a period when there were no crises. So we had a longish period when there were crises, pretty regular, every decade or so. Big crises, huge crises, banks collapsing. And we had a regulated system at that stage. And we gradually deregulated, and it became clear how the central bank should behave. And banks learned how to organize their balance sheet. And we had less and less regulation. And we arrived at that point in the 19th century, and lo and behold, nearly 100 years when there were no financial crises. Banks failed all the time. Pretty much every year they kept on failing, but there was no systemic crash. And I sometimes say, are there any lessons from history? Well, it's not easy actually to find them. Some people find them every day, but it's not so easy to find lessons from history. But I think they were found, and these actors, participants, found their way to how to behave, and there were then no financial crises. So, you know, the rudiments are pretty simple. Banks behave sensibly, but they might fail if they don't. We should have as little regulation as is needed. And the central bank must know how to behave, and that is to act as a lender of last resort. When these elements are in place, we should be absolutely fine. No good saying this time is different. It's not. The same problems keep arising.
Well, indeed, I think this is kind of fascinating, particularly looking at the case of Silicon Valley Bank, which in a sense was a very classic bank failure. There was a run on the bank by people who no longer believed it had the capacity to fulfill its liabilities in the form of repaying its depositors. Now, traditionally in that situation, I imagine, even as, I suppose, advocates of less government regulation, you do see a role for the central bank as kind of a lender of last resort, that when banks need emergency liquidity, that is the correct role of a central bank. But of course, in this case, the government went much further, effectively bailing out the depositors and putting in a guarantee for the depositors. So I suppose the question there is, what should a central bank do, and what is the distinction between that lender of last resort role, which is justifiable, and bailouts, which often are heavily criticised, at least by many economists who are concerned that they encourage risky behaviour?
Well, I think we're agreed. I think Geoffrey and I are agreed on this question. The lender of last resort is there to provide liquidity. Banks may behave themselves perfectly well, and some shock hits the system. Not their fault, they've been behaving as they should. Some shock hits the system, and they're going to run out of liquidity. They turn to the central bank, which is the source of liquidity, and as long as they are carrying good assets, they will get it. But it's frequently misused, it seems to me, so that when a bank runs into liquidity problems, they appeal to the central bank individually, and their liquidity problems are actually quite close to being solvency problems, and the bank attends to whatever they need. And that seems to us completely wrong. Central bank shouldn't do that. Mostly it can't do it because it doesn't have capital on that scale to bail out an individual bank.
They generally provide, the classic British phrase was the central bank lent to the market. What is the market? This disembodied thing. Well, the market is in fact, of course, a collection of banks. And they came to the Bank of England collectively, individually, and offered securities and got cash in exchange. And if they didn't have acceptable securities to offer, then, as the governor was wont to say, look forward to meeting your successors.
But I think it's worth saying that the British system that evolved was quite a good one, in that there was an intermediary, and that was the discount house. And these discount houses, the banks went to them. For historical reasons, they didn't like the Bank of England. They would rather not deal with the Bank of England. But they're happy to deal with discount houses. So they would take their bills to the discount house. The discount house would come to the bank. And that way it was anonymous. A bit like, I tell students, a bit like a frosted glass discount window, only it goes up 6 inches. Through it come bills for discount. If they're any good, cash goes out in exchange. And everybody's happy, and there's no favoritism, there's no excessively good treatment of anyone. There's bills with a price, and they get cash.
Do you find that in this situation that the central banks have potentially conflicting goals here? Potentially we're seeing this at the moment when it comes to monetary policy, where on the one hand, the central banks, rightfully so, we're trying to address the issue of rampant inflation in the economy. They're putting up interest rates, and that's obviously by a lot of analysis has triggered all these issues inside the financial stability side, which is also a goal of the central banks, as well at the same time as potentially undermining economic growth. Is that kind of conflict inevitable and something that needs to be managed by the central banks in these kind of situations?
Well, we've heard this said, and it's said only by people who don't really think clearly about monetary policy. What the central bank has to do if it's going to control inflation, and indeed if it's going to stabilise the economy, have a broad measure of the money supply. In Britain, for example, would be a measure called M3 or sterling M3, a broad measure including time accounts, checking accounts. This would be growing fairly steadily at a rate consistent with price stability, which is roughly at the same rate as the trend growth of the economy, plus 2 or 3% a year.
It's kind of like the Friedman idea of classically just a stable increase in the money supply, so not having any decisions by central bankers.
Well, there had to be decisions, because remember, this is broad money we're talking about. And if there's suddenly a surge in demand for narrow money, for cash, by you, for example, you go to your bank and take cash out, This drains liquidity from the banking system. So unless they get more from the central bank, they have to reduce the lending, so the broad money supply falls. So the central bank is actually possibly, under these circumstances, fairly active, keeping the supply of narrow money such that the supply of broad money is stable. They respond, in other words, to fluctuations in the demand for narrow money, but keep the supply of broad money stable. So the economy is stabilized. Short-term interest rates move around, but not only very short-term interest rates. This has major implications for the long-term bond market, for example. If, as I'm sure you often do, you look at a chart of bond yields in Britain in the 19th century, you will look at something which is pretty well a straight line. That's because long-term interest rates were expected to be stable. Why were they expected to be stable? Because the main factor that drives fluctuations in long-term interest rates is inflation, and inflation was expected to be stable. On any one year, you had no idea what the price level was going to be, but you knew that on average the price level would be stable.
And today, of course, we're in a very different situation where we're seeing kind of quite radical movements in obviously the price level, but also interest rates as a consequence.
Well, the Bank of England has no idea what inflation is going to be. The Bank of England keeps telling us there's nothing to do with them. Depending on which day you ask them, it's either wage increases or price increases.
Well, indeed, and I do find it fascinating the extent to which they're very happy to blame external factors and never consider the fact that the Bank of England is directly responsible for increasing the money supply massively over the COVID era.
Indeed.
A consistent issue here. I mean, it seems at the moment, from a outsider perspective, there's very much a sense of unfairness about the way the existing system works when it comes to banks, which is to say, we have the situation where, on the one hand, bankers are allowed to take risk, achieve a lot of reward for that risk if they do that successfully, but when they fail, it seems almost inevitably that the central bankers will bail them out, or the government will bail them out, for that fear of financial instability. I saw it was very interesting. Martin Wolf at the FT wrote, I think about a week ago, saying banking stands revealed as part of the state masquerading as part of the private sector. That effectively, and in fact some have now suggested, that the solution to the issues with financial instability, maybe we do just kind of nationalise or have 100% fractional reserve banking, don't let banks take any risks whatsoever with depositors, and just very much simplify the entire regulatory system in that sense. And I think even Milton Friedman at one point, had this idea, a similar idea, that in fact depositors should not be in any way gambled with, or any risk taken. It should just be held on the bank's books or held on the central bank's books. What do you make of a radically different system?
Well, you've set out three radically different systems.
Yeah.
You've spoken of nationalising the banks.
Yes.
I do remember, I'm old enough to remember the Labour Prime Minister Harold Wilson, who was in the habit of joking when his colleagues wanted to nationalise something. Yes, they wanted me to nationalise Marks and Spencer's to make it as efficient as the co-op. Well, nationalised banks generally don't work very well in countries where they do exist. Look at the Venezuelan banking system or the North Korean banking system. They're not really very good at providing finance for industry and for agriculture or anything else, and that's the primary purpose of the banking system, transmitting credit from lenders to borrowers. Nationalised banks do not do that well. They're not good judges of risk. It's not their job. What about 100% reserve banking? This means, in other words, that it's like a cloakroom. When you go to the theatre, I can see you're a hat wearer. When you go to the theatre, you take your hat off and deposit it in the cloakroom and get a ticket back in exchange. And you don't expect the cloakroom to lend out your hat while you're in the theatre. Well, cloakroom banks are like that. They give you a ticket and they keep your money in a vault. That's all. This, of course, makes financial intermediation much more expensive, makes it much harder to transmit savings from lender to borrower. So that's not a tremendously good idea either. So we have the 100% reserve banking, bad idea. We have nationalised banking, bad idea. What we need to do is have sensibly regulated banking. Now, the word sensibly in that sense is, of course, very dangerous. Ideally, we should start with a system where banks have no regulation apart from normal company and partnership law, and see how that system works. This does, of course, require responsible bankers. Bankers are not more virtuous intrinsically than anybody else, nor any less virtuous, I may say. We need bankers who are induced to be responsible. What induces them to be responsible? Well, consider the example of Barings Bank, the first time it failed in the 19th century. It was a partnership. The existing partners didn't lose all their wealth, but they lost a very large part of it and never appeared again in the banking sector. That should be the principle now. These people are responsible for messing up. They've messed up. They can't go off with the gains, which turned out. Now, they may have messed up through no fault of their own. They may have done their best and been unlucky. That's tough. You're in banking. The same as any other business. If you open up a retail store, you're unlucky, tough.
So I
that
think
should be the same.
A potential argument against that, though, and just seeing your response to is, well, banks these days, they're very big, they're very complex. There's if they fail, that creates systematic issues across the economy. You end up in at worst a Great Depression or some kind of recession if you just let banks fail, and inevitably. Even if you don't think that's the case, the banks don't have to have that. Inevitably, the political impetus will be towards bailouts and taking all that kind of activity, which will just encourage that risky behaviour. And therefore, you do need more complex regulation because we're stuck in this situation. It's very hard to get out of the status quo, arguably.
Well, that sounds right. And yet, a big example from the 19th century was the bank Overend Gurney and Company. 1866, it was the biggest bank in the country. It was probably the biggest bank in the world because of that, the British economy, so big and dominant. And it was failing. It went to the Bank of England. They didn't get on, which was part of the problem, and so the bank turned them away. No, they wouldn't. Overend Gurney failed. A bank on that scale, it was potentially frightening. The Bank of England had been slow to get to grips with this thing, the lender of last resort. It still was just about almost there. And Bagehot, writing a few years later, said they finally sort of got it in 1866. Slowly, reluctantly, but they got it. And they started lending in the way that they should. Position cleared up, no disaster, no big recession. And what followed? Other banks looked at this and thought, well, that's what's going to happen. This is what we've got to do. We have balance sheets unlike Overend Gurney. So the road was cleared, as it were, for the kind of system we would like, which is a lender of last resort at work with banks who are behaving responsibly and who are not regulated out of existence.
And kind of unpacking that even further here, which is you wrote a paper in 2013 for the IEA, specifically on the idea of capital requirements. I think there are some kind of monetarists or even free market economists who say, okay, well, let's do away with all the complex regulation of the operation of banks, but let's just replace that with very high capital requirements. Let's just say, very simple. You have to have enough capital in stock in order to ensure that if worse comes to worse and that there is a little bit of a run or you make some losses, you have some capital to withstand that loss. Now, why were you against the idea of that kind of a market? Why do you think you can also live without capital requirements?
Well, I would say the capital asset ratios that were laid down when that kind of regulation came in seem to ignore the fact, not quite, but pretty much, on the quality of the assets. You can specify any amount of capital you like, but you need to know what kind of assets they're backing. And there were 2 or 3 different specifications, but they were so, like any kind of regulation, easily got round, or it makes sense, one in the same box as another, when they're in fact completely different kinds of assets. So the hopelessness of imposing that kind of regulation would be my initial reaction to having it. Who knows what kind of capital a bank should hold? Well, the owners and the users of the bank, and why shouldn't they be left to decide for themselves? With always this thing behind it, a bank will fail if it hasn't got the right kind of balance sheet.
And the danger of imposing regulation is that institutions then will tend all to behave the same way to comply with the regulations, which will mean they all have a very similar structure of the balance sheet. Now, if you think again, not so far in the past, to the history of British banking, there were banks such as the British Linen Bank, the Midland Bank, the Bank of Scotland. This suggests that these banks were in some way different in the activities they carried out, and they were, and they had slightly different balance sheets, different assets, different liabilities, because they were dealing with different industries, different parts of the country, and in consequence, they weren't not all exposed to a common shock. So they would be affected differently by different shocks, And that's how it should be. The entire banking system shouldn't be exposed to the same problem. But that's what this regulation does. It makes them all behave in the same way, which is bad. And it also creates an incentive, a temptation, if you like, to press up against the regulations and try to find ways around, when you should more properly be concerned with looking at how to run your bank, keep it stable and profitable.
Well, I mean, this is effectively the same issue with stress tests as well, which have become very popular in recent history. And even part of the criticism in the US context is that Silicon Valley Bank was exempted from some of the stress testing requirements for larger banks. But in reality, my understanding here is that the stress test was not actually testing for a substantial increase in interest rates, which is what ended up causing the issue. And on top of that, what Silicon Valley Bank had was not complex financial instruments. It was treasuries, which you think would be normally quite a secure capital requirement here, which then makes me think, well, all the stress test is going to do is make every bank equally risky and have the same vulnerabilities that then came out.
Yeah, the treasuries are secure in the sense you get your money back if you're going to hold them to maturity. But if, as Silicon Valley Bank did, they held them so that they could sell them if they needed cash, that doesn't make them, they're no longer secure. If it's even 5 years to maturity, and interest rates go up sharply, you might not raise the cash you need, you might sell more. As you sell more, the price is pushed down, and so on and so forth. And that's exactly what was happening in Silicon Valley Bank.
And a similar kind of situation, I suppose, last September with the LDI situation and pension funds, who would have all gone through their own kind of stress test situation. But again, you know, there's uncertainty. Interest rates go up by far more than you expect, and then you end up with a LDI crisis and massive financial consequences.
And this was because the pension funds were carefully regulated and they all did the same thing. And very few of them had sufficient sense to say, are we really wanting to gear up as much as this? Our balance sheets are very long term. We should be more prudent.
But the pension regulators effectively played a similar game to what the banking regulators play. Which is
very strikingly, of course, these regulations applied to private sector pension funds. They didn't push public sector pension funds in this foolish direction.
Well, indeed, that is actually quite an interesting side point there. I mean, another idea that's also talked about quite substantially in this debate is about separating kind of investment banking and consumer or retail banking, is the Glass-Steagall Act in the US, which gets a lot of controversy and blame for banking crises. Is that in any way necessary regulation?
Well, this may be something on which Geoffrey and I don't see quite eye to eye. I'm not sure, but when I ask him, he always persuades me of the right answer. But I incline to seeing it, because of the historical position in Britain mostly, that the commercial retail banks evolved in a certain way, and investment banks alongside them, and they managed to do a very good job in this long period of great stability and so on. Partly because they knew their business. It might have been rather dull, it might not have been an exciting career, but they performed a key function of intermediation in the economy and provided this stability, because the lender of last resort was there to provide liquidity when needed. When we stray into investment banking, then these are more exciting operations, the possibilities are greater, and their losses are potentially higher. Now, that's fine, that's good. People can make money that way. But should the central bank be in any way responsible for the losses that might accrue? I don't think so. So I see quite a good case to be made for fencing off the payment system and leaving exciting things for other people to do. But Geoffrey can persuade me again, I think.
Geoffrey, persuade us otherwise.
Well, you've asked a very good question, because it directs us very well into the dangers of regulation. The danger of regulation, that everyone interprets a question or problem in the same way and answers it in the same way. In fact, there's more than one way of addressing this question. The way that Forrest has done, looking at British history, showing that these banks function pretty well separately, is absolutely correct. But then if you look at the evidence for the Glass-Steagall Act in America, what you can do, and a now late friend, mutual friend of ours, George Benson, did exactly this in a very fine book, the Glass-Steagall Act, Separation of Commercial and Investment Banking, Revised and Revisited. Every home should have a copy. He showed that before the passing of the Glass-Steagall Act, you could separate banks which commingled retail and investment banking and banks which didn't. The former group were more stable than the latter. In other words, if you did commercial and investment banking under one lid, your profits were more stable. Why? Because you were mixing two completely different kinds of income. Now, of course, it does depend on you having the discipline to recognise that the investment banking stream, as you pointed out, Forrest, is more volatile. The discipline to recognise this and take account of that when setting your capital holdings for the other part of your bank. So if you have sensible bank management, incentivised, at risk themselves, then you could run with a system where they're allowed to mingle. But the system worked pretty well in Britain without allowing them to mingle. So there's more than one answer to the question. But to come back to my starting point, this really shows the dangers of regulation because it says it's only one answer to every question. That's not necessarily true.
Yeah, I mean, in a sense, is there, you, as a consumer, you might want to have a choice about whether or not you go for a kind of savings-only bank, and maybe there's lower interest and a lesser benefit to you as a consumer, but you know that it's relatively safe, versus if you want to take more risk, you could go to a bank that does more investing with your deposit. But at the moment, it seems like, again, as a consumer, you don't really have that much choice. Like every bank is more or less doing the same thing.
That's why we have so little competition in British banking. Even entrants have to have roughly similar balance sheets, roughly similar management structures, roughly similar risks management organisations to enter, even if they're 100th of the size, 1,000th of the size of a big bank. That's a major barrier to new entry and a major barrier to competition and therefore to efficiency.
Well, of course, yeah, the regulation itself is inevitably going to be a major barrier to entry just because of all the immense compliance costs.
Yeah, sure. I mean, there was a sad case recently. The Airdrie Bank in Scotland, very nicely behaved bank, closed its doors in 2016. Why? Because of compliance costs. It simply wasn't big enough to pay for all the things that these people were requiring of it. I think it was something like $250,000 per year on compliance costs for a small bank. Of course, the big banks quite like that. They can kill off the competition if that's the way it's going to run, and they might even lobby for regulation so that they're the only ones left who are able to pay for it.
And in the end, the result of this is that you have a situation where you do get these kind of bigger banks that are more financially risky for their failure to the economy. And this seems to be the interesting thing. You made a point earlier, which I found quite interesting, which is you inevitably get more bank failures in the US, but there's a lot more banks in the US. And in the US, best of my understanding, people are far more likely to bank with a local bank or a regional bank, right? And
because they still exist.
And why do they still exist in the US and not in the UK?
Indeed.
How have they been flushed out of the UK? Is it that regulation or the capital requirements, or is it?
No, I think, no, the system became ever more concentrated in the 19th century. So we had about 800 banks. It's hard to put a figure really on this, but say about 800 banks at the beginning of the 19th century, and that had fallen to about 50 banks by the end of the century. And that was partly through banks seeing possibilities in being a bit bigger and merging, two small banks getting together, or a big bank seeing a successful bank in a region that it would like to break into. And so it goes on. There are all kinds of reasons why headquartering in London looked like being beneficial, so get into a bank who's got a headquarters in London. And so we finished up with a much more concentrated system, and that became even more concentrated about 30 or so years later. But who knows what the right level and what it means indeed to be highly concentrated. It's the activity that matters rather than the number of institutions. And the system seemed to settle at a point where it worked.
And in the US, of course, there were regulations which prevented the very kind of activity Forrest described. You saw a profitable bank in another part of the country here, you took it over perhaps. In the US, you couldn't do that because there were barriers on interstate banking. Indeed, in some states, Illinois, for example, you could not, once you'd opened a bank, that was it. You couldn't even have a branch.
Yeah, there's an interesting theory I saw that potentially Silicon Valley Bank could have been bought earlier before in the first weekend it was having issues, but the Biden administration didn't want to allow a bank merger that would result in more concentration in banking, that they saw as an end in itself, having a lot of different banks rather than allowing, I suppose in their mind, to prevent the phenomenon of too big to fail. But if you're already failing, it's
indeed,
you might be too small to succeed.
And they could also have been saved, of course, by having sensible management with exposed to risk.
Indeed, indeed. I'm kind of want to finally pick up on this point about why, really kind of go home about why you think banks really do need to be able to fail. Because I think right now, today, more or less, as far as I can say, the government is not going to allow banks to fail. More or less, they'll maybe allow it to merge on poor terms, but widespread kind of bank failure is something that today governments can't imagine, that they're too scared effectively to do it. So what is the case for effectively for bank failures?
You have to define fail. Fail doesn't mean snapping your doors and that's the end of it.
Yes.
Fail means that this operation is going to be sold off, wound down, or possibly taken over by another institution. And while this is going on, you should make sure that depositors have access to the funds and that people who have loans from this bank don't have to repay them entirely without notice. It has to be a gradual and orderly process. We have an orderly process for firms in general. We do need a different orderly process for banks. If there's an orderly process in place, we don't speak of failure as something dramatic that happens in banking. It's a steady closure. I mean, if we suppose, for example, let me mention two names, they're both hypothetical, I emphasize, that Marks & Spencer is going to fail because it's running out of money, it's not making enough profits. It wouldn't snap down, it would become known that it was available for purchase. Other firms would come along and buy bits of it. The business as a whole would be kept going. You could still get your groceries and your socks if you wanted. The business would still exist simply under new management. That's exactly like as banks should be.
But to say that capitalism requires failure.
Yes.
And that's the thing. That's what we keep saying, that there must be that clear disincentive. If you're reckless, then you'll run into difficulties and you will pay a big price for it. And the ultimate price is failure, however we define it and organize it.
Well, I think it's been an absolutely fascinating discussion, and it's good to put these things in much broader context, because as much as you say we can't learn everything from history, I think there are a few things we can learn from history, and having some broader context, and what we're seeing today is so helpful. So thank you so much for joining us here at the IEA today, Professors Geoffrey Wood, Professor Forrest, Capie. As I said, if people are interested in learning more, we have dozens of publications to your name, but also a very good IEA paper from 2013 on this question of banking regulation and capital requirements, and indeed a different model of banking than what we have here today.
Well, if you enjoyed that conversation, why not watch one of these other videos? And while you're here, remember to hit the subscribe button and the notification bell. That way, you'll never miss out on a single IEA broadcast.